Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 440. I am Brandon Roberts.
And I am Brantley Whitley.
And if you can tell, the surprise in my voice from 440 times we've done this, plus another 188 before all of this. So look at that. We were just... But you are listening to the internet's favorite podcast about
We
life
won't tell
insurance.
you how long we've been doing it, because I'm like, one a week. Almost, kind of one a week.
If you were to divide the number of years we've been doing this by the number of downloads we have, we probably hold a record. And I'm just going to say that and leave it at that and move on to what we came here to talk about today.
The only life insurance podcast that's recorded exactly 440 episodes. That's our record. Until next week.
Yes. Then we'll set a new record.
So, are we going to disappoint everyone? And no, we're actually going to talk about life insurance today. If I look,
we're going to.
Everyone,
let me open up my notes and see what we're talking about today. That's exactly how we do that.
I just gave myself away.
Actually, there's what we do is we come up with like 15 different ideas and we throw them in a hat. And then we get ready to record and we pull an idea from the hat. And I mean, it's like hit record and pull the topic, and here we are.
And shooting from the hip.
That's when you get through 440 episodes, you get I was going to say that good, but let's be honest. You get that okay about doing this.
Yes. The okayest life insurance podcast on the internet.
There you go.
So we're going to make everybody happy and talk about index universal life and whole life today.
Yeah, we're doing all of it. All of it, which sounds like maybe we've done it before, but not with this unique twist, kind of, sort of, maybe.
Yeah.
Today, we are addressing something that has been lingering for quite some time that we have we've rendered an opinion on in the past, but we've been somewhat superficial in our approach to the discussion. And we've dug much more deeply on the subject from a fundamental standpoint, just to address a couple of what we think are nonsensical arguments in either direction. But we're really here to point out that there is a difference in terms of how these two products are likely to grow in value over time.
Yes.
And it's very easy to overlook the actual implication of that.
Right. Mm-hmm.
So, in general...
And we can say this is not theory.
No, not anymore.
Not anymore. We understood the mechanics and the math of it forever. But we have empirical data.
We do. So, the typical discussion about whole life insurance and indexed universal life insurance has largely been one of those super basic risk-reward continuum discussions.
Right.
Where most people, including us, have mostly said whole life insurance is the more stable, year-over-year, less volatility option with likely a lower overall expected rate of return.
Right.
Indexed universal life insurance, on the other hand, is the considerably more volatile in terms of year-over-year return, because the interest earned is going to be based off some sort of index, most commonly the S&P 500, but these days not exclusively. So because of the interest payment being dependent on the movement in an index, that sets the stage for something that could be zero.
Right.
Because an index could be negative for the year.
Mm-hmm. Does happen. That's for sure. Yeah.
And that's the part everybody dislikes, right?
Yep.
Like, I don't want to buy life insurance for the idea of accumulating cash and have expenses associated with that. And then you tell me that my cash isn't even growing. That's an ugly situation to fall into, especially early on.
Yep.
So
particularly bad if it's like year one.
Yeah, people tend not to like that.
Mm-hmm.
But when we buy life insurance, we're not buying it for year one. We're buying it for the totality of years that you intend to own it. And yes,
the truth is it's not going to look great after year one, no matter what. So,
that
in terms of cash accumulation.
Yeah. Mm-hmm. Mm-hmm. So given that sort of paradigm that we just established, like whole life, very stable year over year, index universal life insurance, much more volatile. So the risk averse types look at it and say, oh, well, I don't know. IUL sounds a little too exotic for my taste.
Yep.
We've heard
many versions of that very phrase.
Yeah. The other one that gets brought up a lot is I already own a lot of stocks, so I don't think I need more stock exposure. And they're not the same thing. But that has really caused a lot of people to default to whole life insurance when they probably could have met their objectives much more handily, opting for index universal life insurance.
Right.
Which is not to say that whole life insurance is completely useless. We'll revisit that as we go through this. Mm-hmm. But it is to point out that there are some things about index universal life insurance purely on the accumulation side that we are glossing over when we simplistically say whole life insurance is really safe and stable, index universal life insurance is riskier and much more volatile.
Right.
So we'll first use an example just comparing like the accumulation of values up to like the point somebody might get to retirement. So let's say you're going to buy either whole life insurance or index universal life insurance for the sake of building another position that you could use for income once you get to retirement.
Right.
So we'll assume somebody who is 40 years old, they're going to put $25,000 a year into a life insurance policy, and then they're going to stop doing that when they get to age 65 and begin the year after taking income, theoretically for the rest of their life.
Right. So they're going to pay 25 premium.
Yes, correct.
Over that time frame. Okay.
Mm-hmm. Mm-hmm. So if we run that scenario, we're going to look index universal life insurance, whole life insurance. Index universal life insurance. Cash accumulation by the time we get to age 65 is just over $1.3 million.
Using what assumed interest rate?
6%.
Okay.
6% index credit year over year.
Okay.
Whole life insurance gets us to just a bit over $1.2 million. So they're not that far apart.
Right.
In terms of cash accumulation.
Yep.
One might argue when you look at that and say, oh, well, we're only talking about $100,000 of difference in accumulation value. It probably isn't going to matter much one way or the other. And that's a statement that makes a lot of sense on its face at that very moment.
Yep.
But it ignores a lot of other things that can and most likely will happen, not only up to the point that we get to your age 65, but far beyond that.
Okay. Yep.
So let's continue the comparison by looking at an actual income scenario. Right. So we've said numerous times before that when it comes to general rules of thumb about income generated from a life insurance contract, whole life insurance, we tend to use something around 5%. Index universal life insurance, we tend to use something around 6%.
Right.
So obviously, that's going to change the income numbers. They're going to produce different income amounts here because, one, we have a little more money with index universal life insurance, plus we're also taking a higher percentage from it as income.
Right.
But just to compare the numbers, $79,900 is the income figure we take from the index universal life insurance policy, starting at age 66 and all the way through age 100.
So just shy of $80,000.
Yep, correct.
Okay. And these are, just in case anyone's curious, these are illustrations where static assumptions are made.
Correct.
So
correct. We're assuming the dividend interest rate is the same in every single year for the whole life policy. We're assuming that 6% index credit is the same in every single year for the index universal life insurance policy.
Neither of which we can guarantee you neither of which is true.
Nope, never going to happen. But we got to model somehow, and these tend to be good analogs. So it won't be exactly, but it will be close.
Right.
The whole life policy is $61,000, almost $600, $61,588. So I'm going to say $61,600 and round up.
Yep.
So less, $18,000 less.
Substantially less.
Per year from the whole life policy. Now, here's where it gets interesting in the sense of making an inference that you can actually do something with from this data.
Okay.
If we look at the way cash evolves over the lifetime of the income scenario, what we discover is that the just about $80,000 coming out of the indexed universal life insurance policy create less of a drag on cash growth versus the $61,600 that's coming out of the whole life policy.
Right.
Now, if we get to age 85, what we'll see is that, again, they're not super far apart. Like there's we got 1.65 million in the indexed universal life insurance policy at that point versus it's like 1.2 million in the whole life policy. So the indexed universal life insurance policy's cash value is actually increased slightly.
Yep.
From age 65 through age 85, despite the almost $80,000 coming out each year. The whole life policy is basically sat flat.
Which is not a bad deal either, by the way.
Nope. No, it's not. Now, if we think about this, all right, there's like this $435-ish thousand difference between the cash values at that point. But there's also $360 some thousand of income in excess that's come from the indexed universal life insurance.
Right.
And this is the much more significant piece that we've discussed in private before, but we've not brought up a lot here on the podcast. The fact that we've taken that additional income and the fact that our growth rate is better age 65 to age 85 on the indexed universal life insurance policy speaks to the difference in expensing that goes on between the two products.
Yep.
Because the whole life policy is definitely yoked with a higher amount of guarantees it has to provide to the policyholder.
Yep.
Which is something we've commented on before. But now we're trying to quantify that difference.
Well, also, isn't there a? I'm hitting you with this out of the blue. We didn't talk about this. There's a mechanical difference in how the income, because the whole life we're taking with withdrawal to basis, right?
We are, yes.
First.
Yep.
And then we're taking loans. So, mechanistically, in terms of the policy's ability to earn, you're sort of hurting the whole life insurance policy.
You would think that, but if we were to go back and run it just as loans on the whole life policy, it actually wouldn't do as well.
Yeah, that was my point. I was going to get around.
Okay.
This is actually the best design for income, but it also gives it a slight disadvantage, I guess is what I'm trying to say.
Because whole life insurance can't do what indexed universal life insurance can do.
Right.
In terms of loan functionality.
Right.
Yeah. Okay. That is correct. So there are things, and when we've had a more,
meaning you're keeping more of your cash in the IUL working and earning for you, whereas in the whole life insurance, to maximize the income, you're actually withdrawing cash before you turn the loan feature on.
And that statement has a substantial implication to it that is very easy to overlook. Because most people will look at this and think, oh yeah, okay, more of my money is still there at work, fine. But they're looking at a ledger that assumes just 6% year over year. Realistically, more money still working for you could be in any given year 10.5, 12, 15% growth versus 6, which is significant in terms of what it will deliver to you as it compounds year over year over year.
I was going to say as a long-term impact. Yep.
And we've noted years and years and years ago that something that's super easy to overlook with indexed universal life insurance is the fact that there's no reallocation for risk. So unlike somebody who's heavy stock exposure, normally what they do as they get older, they tend to ratchet back and they tend to look for things that are less risk on.
Right.
Because they don't want to risk the possibility of a negative year where they lose additional value and they have to take a withdrawal. That compounds the negativity of things and gets you closer to zero more quickly than you'd like.
Right.
But indexed universal life insurance doesn't deal with that because index universal life insurance can't go below zero in terms of the interest earnings.
Right.
Yes, it's true that if you get zero interest earnings, expenses still need to be deducted from the policy.
Yeah.
But it's not the case that if the index is down 10%, you're going to have 10% negative interest applied to your cash value.
Right.
And when you have an index universal life insurance policy that is put in force properly for the sake of building cash and generating income, the expenses when you're age 70 should not really be any more than like a quarter to a half of 1% of the cash value.
Right.
So yes, you can go down, but the worst case scenario is that you go down by what would be kind of a typical expense ratio for most mutual funds.
Sure. It's negligible. Yeah. And some people, we've worked with some people who are very sensitive to that, that fact. Mm-hmm. And one of the things we've done to help them sort of offset the inevitable years where you get nothing, is to place some amount of money, relatively small amount of allocation toward the fixed account, such that whatever fixed interest earnings they get in that would more than cover the expenses in the policy.
Yep.
So,
yep, that's an option.
I mean, they're sacrificing a little total return, obviously, for doing that, but they like the peace of mind. So that's a way to do it.
Yeah, it is. And then there are other products on top of that have floors,
sure,
that are higher than zero, and that gives you an option to put all of it in whatever index account as long as it has that 1% guarantee on the bottom. So that's another way of getting around it. There are the number of options that exist in the marketplace of index universal life insurance is quite wide.
Yeah.
And so the thing that always makes me chuckle a little bit when I hear other people talk about index universal life insurance, especially usually framed in a more negative sense, is they kind of act as though they're all the exact same.
Right. They're generalizing about it. Yeah.
These super strong assumptions made about it to say things like, well, in a negative index year, you're going to lose money because the expenses have to be deducted from the policy. And that's all they say. And they leave it at that because that seems like a really bad thing.
Yeah.
But when we actually look at it and quantify what the net impact is, and we realize, oh, you mean like if I'm 70, I'm going to lose 0.25% of my cash value, worst case scenario, for a best case scenario of like 10% growth? That doesn't seem like a terrible trade-off.
Right.
So that makes it a little bit different when we put it in that context and we start to understand how it really works in practice. Yep. The guarantee element, so the drag on cash value for whole life insurance is much more significant as time goes on. And the piece that makes life insurance unique is the fact that in general, we have a much better understanding of where things are going to fall in the future with life insurance than we do most other options to save for retirement.
Yes.
Like when we look at a ledger and we see what the projected cash value of a life insurance policy is, be it index universal life insurance or whole life insurance at age 95, for example, we have a much greater sense of confidence in that materializing than we would if it were an investment in the SPY.
Sure.
We just do. And so when we're comparing the two to one another and we see that the cash accumulation at age 95 is substantially larger with, let's say, index universal life insurance than whole life insurance. Some people say, well, who cares? Like by age 95, I might be dead. But my point to them has always been, but if we are on a path to a significantly higher amount of accumulation with index universal life insurance, that means we'll be able to extract more value from it from age 65 to age 95, for example.
Right.
And that's the part that a lot of people are overlooking. And that's what drives this difference in numbers, this $61,600 per year versus $79,900 per year. And keep in mind that because we have a good cash cushion in the index universal life insurance in this example, that affords us the opportunity later on to decide, hey, what if we wanted to take a little more money out?
Right.
That's totally okay. in terms of the indexed universal life insurance policy. The whole life policy, because we're seeing cash eventually decline, like if I go out to age 95 in the whole life example, cash at that point is $865,000, actually $866,000 if I round up. So it's going down. And the reason it's going down is because, again, the guarantee that is associated with whole life insurance is increasing, and it's increasing exponentially over that time frame. Because there are guarantees regarding the death benefit that the insurance company must maintain. Universal life insurance doesn't have those same guarantees.
Right.
And that does tend to make some people a little uneasy. But the one thing that we're typically really bad at as humans is evaluating the actual difference in those guarantees. And
in terms of what they actually mean.
What they mean and what their actual costs are and what we need to do to hedge some of them.
Yes.
And
to further complicate it, I mean, we all know that human beings have no grasp of time.
No.
So looking out over 60 years, it's just an added degree of difficulty to all the things you just said.
Right. So it's the difference in terms of the risk profiles are extremely unintuitive.
Right.
Because most of us think of them very much linearly and in absolute terms. Indexed universal life insurance is riskier because it has fewer guarantees. Full stop. That's it. That's bad. But if we try to actually understand the difference in those guarantees and what they mean, we start to realize that they're not that far apart.
Right.
And the distance between the safety of whole life insurance and indexed universal life insurance is a fraction of the difference in terms of the safety between indexed universal life insurance and being invested in a passive indexed ETF.
Yep.
For example.
And I want to add, this is something we've talked at length about in past episodes, but this could be someone's first time listening.
Yeah.
When statements are made about the guarantees versus non-guarantees, guarantees with whole life, non-guarantees with indexed universal life, and people go, well, see, that thing could fall apart. They're not factually wrong.
Yep.
But the context is important.
Yep.
And that is to say, if you have an indexed universal life insurance policy, let's approach it from the death benefit angle, because I think it's easier to understand. And this is something we've talked about. If you say, I want a $1 million permanent cash value life insurance policy, and I want to compare whole life and I want to compare indexed universal life, and that's the only qualifier you give.
Okay.
In many cases, not with us, but in many cases, what you're going to get is, well, Mr. Jones, the $1 million whole life insurance policy is, let's just say it's a 40-year-old. We'll go with our example here. And it's, what's a good number? 15,000 a year?
Sure.
20,000 a year? For that $1 million policy. Or you could buy this indexed universal life insurance policy and it's 6,000. And people go, well, I like the 6,000 more than the 15,000. The problem with the non-guaranteed aspect of IUL or any universal life insurance, whatever flavor, is that if you go off of what is quote unquote required to support the death benefit at the time you bought it, meaning the minimum funding that you can to have the policy in force at $1 million at age 40, you will be woefully underfunding the policy.
Yeah.
And so you may not have any problems in the first several years. You may not have any problems for a couple decades.
Yep.
Who knows? But you will eventually have problems. And so that's the disconnect. It's almost like we have to talk about it in terms of the common vernacular. It's indexed universal life insurance. It's whole life insurance. what we're doing, to toot our horns here for a second, is totally different than what 99% of the marketplace is doing.
This is true.
With the products themselves. Not that they're different products. We're using the same products other people use, just in how you set it up and how you design it.
Yep. This is true. Now, to your point, where what we would generate for a let's say permissible premium on index universal life insurance being substantially lower than whole life insurance.
Yeah.
We would then tell you, don't do it that way. If you just want to buy it for death benefit, look at index universal life insurance with a matched premium to whole life insurance.
Right.
And the pushback that we would get then is, yeah, but there are guarantees that whole life insurance provides that index universal life insurance does not. And that creates a difference in terms of risk profile that is potentially bad. And the same conversation comes up on the accumulation side, where people are just buying to accumulate cash value versus have a permanent death benefit in place. And again, our point has been, yes, they're different, but I don't think they're different by the same amount you think they are.
Right.
And again, the rules of math do not change here, but they are extremely unintuitive.
Mm-hmm.
And so just because I am me, I actually came prepared with a little bit of a math thought exercise to try and explain the concepts at play here that drive these differences and why I have been saying what I've been saying for so many years.
Yeah.
So, this takes me back to college probability classes. We're going to talk about the birthday paradox. So anybody who's got a little bit of a math background is going to know exactly what I'm talking about. Those who don't worry. We're not going to do the math. We're just going to talk about the numbers.
I'm in those who don't camp. So there you go.
So the birthday paradox is a thought experiment that says, all right, how many people do you need to put in a room to make the probability that at least two people have the same birthday very, very high?
Like same as in day and year, or
excuse me, day of the year. So,
okay.
So how many people do you need in a room to increase substantially the probability that at least two people were born on the same day? And let's ignore leap years and things like that. We're just gonna pretend like they don't exist right now. So most people look at that and they start to think, it's going to probably be a big number because you got to have a lot of people and you got to have same birthdays and things like that. The number to get to 50% is like 25 people. And the number to get to like 99.9% is 70-ish people.
Wow.
That's it.
That's a lot less than I would have thought.
Okay. So that's all you need to substantially increase and almost make certain that at least two people are going to have the same birthday.
Right.
Now, I want to put it in this context. How many people do you need in order to guarantee absolutely, unequivocally, no doubt, no possible failure here, that at least two people will have the same birthday?
100% probability.
Yep. So to get to 100%, you need 366 people. That's simple.
Yep.
If there's 365 days in the year and you put 366 in there, it's impossible for somebody to have been born on the 366th day of the year. Again, let's pretend leap years don't exist.
Right.
So think about that difference between 70 and 366.
Yep.
There is a mountainous lake in between them in terms of numbers.
Yep.
Now, think about it in the context of expense. Let's say that it's going to cost you $1 for every additional person you put into the room. And I tell you that you want to make the probability of at least two people having been born on the same day as close to 100% as you can get.
Mm-hmm.
As cost effectively as you can get it.
Right.
Are you going to spend $70 or are you going to spend $366?
I'll take 70 please.
Yep. And that is the difference in terms of the risk of guarantee existence and non-existence between whole life insurance and index universal life insurance in a lot of cases. Especially when we're talking about cash accumulation, because when it comes to cash accumulation, we are minimizing
policy design.
Yeah, we are minimizing death benefit as much as possible.
Yes.
So when we are controlling,
we're minimizing the expense. That's what we're doing.
Right. When we're controlling death benefit in that context, the risk of things going sideways on us is so unbelievably small.
Right.
It's not zero, but it's so unbelievably small that the likelihood it becomes a problem is, as I've told others in the past, if circumstances were to materialize where it became a problem, there are other things going on in the world, and the cash in our life insurance is not going to be our primary concern. Right.
And it also assumes you can't make any adjustment.
Which is false.
Which is totally false. The birthday paradox, you can't adjust anyone's birthday.
No, you can't. You can't.
It's not going to work. But in an insurance policy, you can make adjustments.
You can. And you can further minimize the probability of failure in those cases.
Yes.
So
long in advance of the failure, by the way.
Yep. And we have had people buy indexed universal life insurance and not do what they plan to do.
Like all of them?
And we have made adjustments in some cases to accommodate the fact that things shifted in a different direction.
Yes. And even some cases where adjustments should be made and people won't adjust, and things still work out okay.
Things are going great. We've talked about a policy that we have in force now for well over 10 years that has done fantastically well, and we're going to save the exact details for an upcoming episode. But just know that what we originally projected for index credit versus what it's actually accomplished are a world apart, realistically.
Yeah.
Despite a cap rate that has declined substantially over that time frame.
Mm-hmm.
And the opportunity for index universal life insurance to have that upside volatility that creates better than expected growth of cash does lay a lot of things on the table that we have not seen materialize for whole life insurance during our careers.
Right. And we'll never.
Yeah.
I mean, because that's not a critique of whole life insurance. It's just a fact of whole life insurance doing what whole life insurance does.
Yep. Again, from the probability standpoint, it's not an impossible scenario necessarily. It's just highly unlikely to happen.
Yeah.
Because the forces that would need to come into play to force that dividend up to a point where they would create such a substantial difference, it's never happened.
Right.
And it's very unlikely to happen.
Or I guess on the other side could be some relaxing of regulatory, constraints that allow them to do some things that they can't currently do with whole life insurance.
Which on its face might introduce some risk that we don't want anyway.
Exactly. That's not going to happen. I mean, I don't see a world where that happens, I should say.
No. Now look, none of this is to paint whole life insurance as bad. None of this is to say you shouldn't buy whole life insurance. And none of it is to tell the people who bought whole life insurance you are suckers. And that's nope.
Not at all.
Nope. There are definitely times that whole life insurance is indicated.
Yeah.
There are other times that indexed universal life insurance is probably going to shine brighter.
Yep.
And people have tended to latch on to platitudes or anti-platitudes about indexed universal life insurance and made what makes sense from a purely non-numerical standpoint.
Right.
Like I understand the theory and I'm going to apply the theory absolutely. And they come to the wrong conclusion.
Yep. And look, in this case, I'll call this out. In the case where we're looking at someone funding a policy from age 40 to 65, this is one of those cases where index universal life insurance shines.
Yep.
The divergence, if you have a longer time frame, the divergence between the two gets bigger, gets much wider.
Yep. Now, if this person were 10 to 15 years older, much, much different story.
And we're only planning on funding the policy for 10 or something like that.
Yep.
That would change the conversation entirely.
Mm-hmm.
So it's definitely a case by case sort of situation.
Yes, it is.
All right, that's enough. We've gone into the bonus round.
That's good enough for now. So I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.